In Greek mythology, their army led by Agamemnon, after fighting unsuccessfully for 10 years to capture the city of Troy, one day left behind a wooden horse at the city gates and apparently abandoned their siege and left. The confused citizens of Troy, thinking it was a gift left behind as a mark to honor their fighting spirit, wheeled the well-crafted horse into their city, not knowing that hidden inside the hollow were fighters waiting for just the right moment to strike. As the Trojans celebrated their apparent victory in drunken revelry, in the dead of the night the assassins emerged and opened the city's gates, as the Greek army came roaring back, achieving by deceit what they could not win by their strength. Similarly, after India's largest private bank revealed,
People's Bank of China has increased its stake in HDFC Bank from 0.8% to 1.01%.
the Indian government, fearing just such an opportunistic Chinese takeover of Indian companies, whose valuations had been badly hit by the coronavirus pandemic, used it as a perfect excuse to announce a policy that they had already been working on for some time, well before China's intrusions in Ladakh and Galwan.
A non-resident entity can invest in India via the automatic route, except those countries that share a land border with India.
In plain English, the new rule PN3 means that Chinese companies now need government approval before investing in India. Both for FDI, foreign direct investment, a more long-term and stable form of investing like Chinese car manufacturing plants in India, and FPI, foreign portfolio investment, aka hot money in the Indian stock market, like the one used to buy HDFC Bank's shares. Companies from other countries don't need permission to invest in India, except in defense, space and atomic energy. Like India, Italy too introduced the Golden Power Law in April 2020 after it found that Chinese companies bought $4 billion worth of shares in the Milan Stock Exchange when prices dropped 40% during the coronavirus crisis. Spain, Germany, USA and Australia took similar steps to protect their interests falling into Chinese hands. It is believed that many big Chinese entities are controlled or at least forced to obey orders of the communist rulers in Beijing, who can, through the use of technology and apps, acquire information on Indian citizens and identify those they can coerce, bribe, honey trap, or blackmail into doing their bidding. Unfortunately, most affected by this restriction will be the Indian startup ecosystem, in which the Chinese have invested up to $3.9 billion in a total of 90 startups. Chinese companies like Alibaba, Tencent and Fosun are large investors in 18 of 30 Indian unicorns. As ties deteriorated between the two countries after the killing of 20 Indian soldiers in Galwan, India took retaliatory measures by banning 59 Chinese apps, including TikTok, WeChat, Hello, Vigo, UC Browser, ShareIt and later 47 other such clones. Excluded the participation of Chinese companies like Huawei and ZTE in 5G technologies and in government tenders that are responsible for between 20 to 30% of India's GDP spend.
Chinese companies won't be allowed to participate in highway projects and will be kept out in sectors such as MSMEs.
Realizing that stopping trade or curbing imports of Chinese products will only end up hurting India at this stage, Prime Minister Narendra Modi's agenda of
Atmanirbhar, self-reliance,
is a call of distress to Indian manufacturers who run a $48 billion trade deficit with China, importing huge quantities of intermediates and components. 95% of motors used in washing machines are imported from China. 80 to 95% of penicillin and azithromycin come from there. 80% smartphones and compressors for air conditioners, APIs 68%, furniture 57%, electronics 45%, smart TVs and inorganic chemicals 38% each, capital goods like machinery 32%, fertilizers 28%, automotive parts 25%, telecom equipment 25%, and 130 out of 600 planes leased by Indian Airlines are from China. Earlier calls vowing to cut drug imports from China post-Doklam fell flat, with APIs rising 28% and miscellaneous pharma items 58% since the 2017 crisis. However, not all things Chinese are national security threats. Many are beneficial for the economy and provide jobs. SAIC Motors, under its British brand MG Motors plant in Halol, Gujarat, provides 1,700 jobs. while the Great Wall Motors plan to invest 7,500 crores, $1 billion in Talegaon, Maharashtra, providing 3,000 jobs that has now been put on hold, as have others. 50,000 Indian jobs are at risk as collateral damage when the supply chain for Chinese mobile companies such as Vivo and Oppo gets disrupted, who with a 75% share of the Indian mobile market are in the process of localizing their manufacturing, already making 2/3 of their components locally. For example, Xiaomi has 7 manufacturing facilities in India with a factory workforce comprising 95% women, many of whom may become jobless. The Indian head of the Chinese company points out the irony of restricting Chinese FDI. US branded phones are 100% made in China, while so-called Indian brands just change the logo and call it an Indian phone. Like the US banned the use of Huawei's 5G equipment in broadband networks and refused to let a Chinese company acquire one of its top chip makers, Fairchild, India too can make a list of strategically important companies and ban their takeovers by foreigners, Chinese or otherwise. But the blanket restriction on every Chinese investment may be the wrong medicine at the wrong time, especially when lockdown has decimated the job market. It is an accepted business practice to bottom fish, that is to invest in assets that have fallen and are considered undervalued due to internal or external factors. The takeover of South Korea's Ssangyong by Mahindra and Tata's buyout of Britain's Jaguar Land Rover were also distressed sales. But it is the lack of trust in Chinese more than anything that made India take these steps. Previously, India did not participate in China's Belt and Road Initiative, refused to join RCEP, the Regional Comprehensive Economic Partnership that would have made Asia a tax-free region, allowed Huawei in 5G trials after much deliberation, and permitted the $1.1 billion 2017 sale of Hyderabad-based pharmaceutical firm Gland Pharma to Fosun after much dithering. However, China's investment in India are still small. Just 114 Category 1 FPIs registered in India, while by contrast, the US has 2,867. Not allowed to invest directly, Chinese investors who may try to circumvent this by routing their money via US-based cat funds will not be able to do so, as all funds are now asked to disclose names of beneficial owners, who are the ultimate beneficiary of profits, properties or investments, often hidden underneath tons of paper and a web of various offshore entities. Unfortunately, different laws have different definitions of this term, which the government will do well to standardize. Section 90 of the Companies Act 2013 puts it at 25%, SEBI caps it at 10%, while the Money Laundering Act is ambiguous about the percentage. And even though the Chinese investment arms, China Corp, ICBC and SAFE together manage $4.5 trillion, overall their actual investment in India is estimated to be approximately between $18 to $22 billion. $4.5 billion via FDI, $3 to $3.5 billion in equities and bonds by PBOC, including stakes in HDFC Bank, Ambuja Cements, Piramal Enterprises and a listed fertilizer company, $4 billion in Indian startups, and $4 billion via Hong Kong, mostly invested in the Indian stock market. Sovereign wealth funds of other countries also hold large stakes in Indian companies. The government of Singapore owns a total of 3.23% in Indian companies, while the Abu Dhabi Investment Authority holds a little over 1%. China played down this demotion by not raising the issue at its regular briefing of the Chinese Foreign Ministry, but left it to its Indian embassy in New Delhi to issue a statement.
India violated WTO's principle of non-discrimination. We hope New Delhi will treat investments from different countries equally.
And continued to deliver 390 tons of medical supplies to India, including rapid antibody test kits, thermometers and PPEs. It is pertinent to note that when Germany tried to impose restrictions, China invoked World Trade Organization rules and the need for global cooperation, but did not do the same with India. From the 1st of Jan 2020, China introduced a new reciprocal principle law allowing it to take retaliatory action against companies that operate in China that are from countries that discriminate against Chinese investors. However, till 2018, Indian companies had invested just $1.09 billion in China. IT and agricultural companies have for long complained of market access restrictions anyway, so their reciprocal law will have limited effect on India. In fact, India's new restrictions may compel Chinese companies to sweeten the deal with better terms and allow technology transfer or licensing. On the other hand, the more China invests in India, the greater will be India's leverage over them, since it can threaten rule changes to China's disadvantage. India has a long track record of letting foreign investors in and then bashing them. Just ask Walmart, which paid a whopping $16 billion to acquire Flipkart in the hope of capturing the large Indian market. And just when it seemed that Walmart and Amazon would now dominate e-commerce, the government changed the rules for 100% FDI in food retail, among others, to the benefit of local companies. At a stroke, Walmart's $16 billion buyout seemed like a huge overpayment. Who recently injected another $1.2 billion into Flipkart to keep up with competition. Vodafone won a $2 billion dispute over capital gains tax in the Supreme Court. But the government changed the law with retrospective effect, making Vodafone liable all over again. Nokia built a giant phone handset factory in Tamil Nadu. But the government raised an inflated tax demand of 10,000 crore, $1.5 billion, eventually settling for 1,600 crore in 2018, forcing Nokia to shut down. Earlier in the 1950s, it was Burma Shell, Esso and Caltex. In the 1970s, IBM and Coca-Cola. It may be safe to say that foreign investors suffer the greater risk while investing in India. So what if Chinese investors are really the Chinese Communist Party? Next time India fixes a foreign investor, it may well be the Communist Party. This fact was proved when India's ban on Chinese apps, especially TikTok, which was ByteDance's biggest market, left Beijing fuming. Then People's Bank of China quietly sold part of their shareholding in HDFC Bank so as to come under the 1% foreign holding limit and avoid public disclosure. Equally quietly in May 2020, SEBI extended PBOC's investment license by 3 years. India will be tested once again as the Hyderabad-based but Chinese-controlled Gland Pharma recently approached SEBI to raise 1,250 crore through a listing in India. Vivo made it easy for BCCI by pulling out of the IPL title sponsorship, but it remains to be seen if they will accept the over 500 crore of advertising from Chinese brands. It's time India re-evaluates the bogey of the East India Company that still haunts policymakers of today, of how a trading company came and ended up ruling the country. Because that colonial era is long gone. India is today a powerful voice in the world. Its fair and independent judiciary and a huge educated and aspiring population are the target of every company, including the Chinese. Let the Chinese come, be it on the border in Doklam or Galwan, or the financial market. India will not be fooled by a Trojan horse. In fact, we may turn the tables on them. BISBO's limerick. China tried making trouble on India's borders. India retaliated by cancelling Chinese orders. Tit for tat instead of rat-a-tat-tat might help overcome the border disorder.